Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks having a tough time today. That's after a deeply disappointing jobs report. And we're learning now that President Trump is ordering the commissioner of the Bureau of Labor Statistics to be fired as a result. There's just an hour to go until the closing bell. Let's get a quick check of the markets. You've got red across the screen. The Dow is down about 550 points. The S&P 500, your broad gauge, is down about 1.6%, and your tech-heavy NASDAQ down about 2.2% right now. Let's welcome in here. We've got Joe Brusuelis, Chief Economist at RSM, along with our Data and Markets Editor, Jared Blickery, who are all joining us throughout the show to break down the headlines. Kicking off with you, Jared, for a snapshot of the trade today.
All right, well, it's right across the board. Let's dig into some of the details here, and we'll begin with a chart. This is a Dow down 575 points, 1.31%. You can see took a gap down on the open. The report was released an hour beforehand, but we spent the entire day just camping out by those lows there. And here's the NASDAQ down even more, no thanks to Meta. We'll get into some heat maps later. Very close to the lows of the day here. And the S&P 500, similar story, down 1.67%. And finally, the small caps, which are also down here. Now, I got to show you what's going on in the bond market because these are some of the biggest drops in yields that we've seen since April, and that would be around Liberation Day. The 10-year down 14 basis points to 4.22%. Here is the 30-year down 8 basis points to 4.8%. Even the 13-week T-bill yield down 5 basis points. Very unusual to see this move this much intraday, but the calculus on more Fed rate cuts are going up right now. Meanwhile, the U.S. dollar, which had been up 6 straight days, that is down 1% today. That's quite a bit for the world's reserve currency. And I will just show you one market that's going up. Gold futures. Gold up to 3,400 even, and we are seeing a 1.5% move there. In sector action, we got defensive leading, healthcare, staples, utilities, the only ones in the green. To the downside, consumer discretionary, that is down 2.61%. Tech is down 2, so is financials. And a quick look at the NASDAQ 100, where we see a lot of red here. Amazon down 8.3% after earnings. Meta, which was up 11% yesterday, down 3% today. And NVIDIA coming off record highs, that is down over 2.5%. I did say I'll leave it there, but let me just show you a quick picture of the Dow and a pretty red board there, except for some names in staples and greens. Again, those are the defensive sectors, so very much a risk-off day.
All right, thank you, Jared. I'm going to see you in a bit later here. The U.S. adding just 73,000 jobs in July, throwing another wrench into the Fed's rate path going forward. The president, meanwhile, directing his team to fire the BLS commissioner. And Joe, that is where I want to start with you. So Trump, posting on social media here, directed his team to fire the commissioner of labor statistics. You saw that headline, Joe. What did you make of that headline? Would that be a first, Joe?
Well, it would be. I mean, I wish I could say that I was surprised, but I'm not. Like all economists and people who work as professionals in financial markets, we've been watching how the White House has been addressing the federal government. And it's unfortunately not surprising that he's removing the BLS basically because he didn't like the number today. Now, this is not going to instill confidence across asset markets in the policy apparatus. Moreover, this is really unfortunate. It's similar to the attack on the Federal Reserve's independence, is it just undercuts the veracity of the data. And I don't mean that in they're fixing it. What I mean is that the federal government has made a decision to not invest in the collection of the data. When you do that, you're going to have larger revisions. There's going to be more of them, and it's going to cause more volatility across financial markets. So this is a classic lose-lose proposition here, Josh.
The question also then, Joe, immediately is who would then step in and take this job, knowing that this could be the outcome?
Well, I don't know. I don't know anybody who'd be willing to step in and take that job. That's the problem. No one's going to be next up because they're going to think, well, when the business cycle finally ends, and business cycles tend to expire after long periods of time, you're going to get fired for it. So why take the job, right? And that in a nutshell is the problem. Is it just undercuts any idea of confidence in these data. Now, I want to be fair here. Revisions to economic data in general and the jobs data in particular have been an issue for decades. You know, for a long time, the plus or minus on jobs day was 50,000. Now it's 100,000. Well, you know, again, if you make less of an investment in the collection of this critically important data, you're going to have a larger standard error, right? And that's just where we're at. So I don't see this situation getting better. You know what I'm really concerned about, though? I've got a Bloomberg terminal. Sorry for saying that on air.
It's
right?
okay, Joe. We'll forgive it.
But I've got alternative data all over the place in front of me. What about the guy who trades, who's the retail trader, or the smaller mid-sized business owner who doesn't have that data, right? All you're going to create is you're going to cause an intensification of the bifurcation in this economy. It's bad enough that we've got a K-shaped economy with too many people on the lower spur of the K catching hell every day, right? This will not help. The further we call into question the collection of US data, the greater the bifurcation in this economy is going to be. It's bad enough that we have too many haves and have-nots, but if we create a situation where there are people who have alternative data that can buy further alternative data, you're going to those who have information and those who don't, and it's just going to make the situation worse.
Well, listen, we feel like the market's not loving this jobs report or the report we were just talking about there. Pair that with the new tariffs, and we were looking at stocks selling off 1 hour before the closing bell. I want to welcome now Jordan Rizzuto, Chief Investment Officer at Gamma Road Capital Partners. We also got Blake Gwynn, Head of U.S. Rate Strategy at RBC Capital Markets. Joe Brusuela still with us as well. Blake, I'll start with you. Give me just your reaction to the jobs number, Blake, the revisions we saw. What did you make of it? What do you think the Fed made of it?
Well, it wasn't great. I mean, let's get that out of the way up front. But I do kind of remember back to last year. We had another freak out about the labor data in August, as it were. And we were on the other side of that pretty vehemently throughout the 2 months after that and into the 50 basis point cut, where we were saying, look, if you really look at some of the things that are happening underneath the headline data, there's actually some reasons not to be overly concerned. And so, again, I'm not going to say this was a good print. The revisions were certainly bad, but I think there are some reasons to kind of push back against this being a complete disaster.
Were you suggesting there, Blake, listen, it was encompassing a period that tax bill, tariff uncertainty, there was just a lot of balls in the air?
Yeah, so one thing is that, the downward revisions that we're seeing were kind of peak uncertainty, right? So I think if anything, if you go back to that May, June period, a lot of people were actually, including us, were a bit surprised that we weren't seeing more impact from these tariffs. We actually expected more kind of freezing up of hiring because we thought corporations would be in this kind of deer in headlights mode where they just didn't know what the outlook was going to, be. You took trade policy and just shook it like a snow globe. Of course, people were going to stop hiring. So it was actually kind of odd to see how strong things had performed. And now this is almost kind of some verification that, yeah, things were very uncertain at that time. The positive side is that some of that soft data has started to bounce back. I think tariff policy, even if we're ending at a place where maybe effective rates are higher than you'd like, if we just solidify the policy, then companies can kind of move forward and maybe that valve turns back on a little bit. The other thing that I would just say that I look at underneath the headline numbers is that permanent layoffs are still very low. If this is still a story about new entrants not finding jobs, slow hiring, new entrants being unemployed, that to me is very different than if we're starting to see rising layoffs and people really lose their jobs, because that to me is much more corrosive for the environment than people entering the job market and just having a harder time getting placed.
All right, Jordan, I want to bring you in here as well. Get your thoughts on the report. Jordan, also, what you think Jay Powell made of it. Did it increase the odds of a September cut, in your opinion?
I think it certainly did. I mean, market pricing is certainly reflecting that today. So we're seeing at the short end of the futures curve, a major bid. Interestingly enough, as it relates to monetary policy, we like to look at the relationship between rates along the curve, and particularly at the short end right now, you're seeing the 2-year is persistently lower than the overnight rate. And historically, that has suggested that policy is restrictive. I agree with a lot of the points Blake just made that we're not actually seeing that in the hard economic data that's been coming out yet. And so, it just makes it even tighter for the Fed to walk this tightrope that they've been walking coming into this year.
Did you see anything in that report, Jordan, that made you rethink how you want to be positioned in the market?
Our biggest takeaway from the report touches on what Joe was touching on earlier, which is the size of the revisions. First and foremost, they've always been large. They should be even larger now because of the policy changes that we've seen and the funding changes for the actual collection of the data. But what you do tend to see is that there is more or at least what we see in our research, there's more informational value in the revisions over time. And so, the big takeaway from the report this morning for us was the size of the revisions, right? And when you're applying that to something that tends to be more of a lagging indicator like employment is for the most part, it muddies the water. It makes the decision-making process that much more difficult.
Joe, you're, as a resident economist at the table, your take on the report and what you think the Fed made of it.
All right, so I think that it reaffirmed our core baseline outlook for the second half of the year, which is stagflation light. The economy's slowing. The fingerprints of immigration and trade policy are all over the report. Mm-hmm. You can see slowdowns.
You would draw a connection between that labor report and tariff policy.
Well, that's right, because you can see the weak pace of hiring with the 258,000 decline, the 2-month back revisions. You can see it in goods production. You can see it in construction. You can see it in manufacturing. Mm-hmm. You can see it in leisure and hospitality. My God, guys, we added 9,000 jobs in leisure and hospitality in June and July. These should be the 2 biggest months, right? Moreover, over the past 4 months, there's been a decline of 1.4 million foreign-born workers. It was 321,000 this month. When you pull that many people out of the workforce, well, what happens is you tend to mask unemployment, right? If you noticed today and looked at the unemployment rate, out to 3 digits, it barely missed the jump from 4.1 to 4.3. So I think we're now poised to go higher. And that's the number I think that you want to watch. Moreover, Jay Powell said that's the number they are watching, right? Because the Fed's in a horrible situation now. Inflation is going to move higher, right, for the next several months. Their dual mandate is now at a crossroads, right? They're going to have to choose, do they cut because they want to protect the labor market, or do they need to remain on hold to make sure inflation doesn't get out of the box again, right? Normally, you get an oil shock or even a tariff shock, it should be a one-time pass-through effect to the price level. But because we see a couple things, inflation expectations has migrated upward, right? 4.5% in the University of Michigan's 1 year. The New York Fed's well above 2%, it's in the 3s. And then I see policy proposals like rebates for tariffs to give Americans, especially down market Americans, a little bit of help. Okay, if you boost artificial demand, or aggregate demand artificially without a simultaneous increase in supply, what happens? You get more inflation, right? So that's why you saw that move this morning in probabilities of the rate cut. It was 38% at 8 a.m. It was 85% when I got in the car to come over here, right? Yes, people, I know they're thin in the liquid markets. Don't freak out. But nevertheless, right, as a policymaker, you have to step back and look for the signal rather than the noise. And right now, I'm not at all certain a September rate cut is in their cards or makes sense.
But Blake, let me get you that. Following on Joe's point, would you agree generally the Fed finds itself in a rough spot here, and that a cut in September doesn't necessarily make sense?
Oh, 100%. I mean, I spent most of my morning today trying to tamp down people asking me if they were going to go 50 in September. Our call is for a first cut in December. People were asking me if we're pulling that back to September. I would point to what I said earlier about I think there are some reasons that you might expect a little bit of positivity, to come in the next few months. When we cut 50 last time around on that SOM rule trigger that they called it, and the big ramp up in unemployment, the data turned around right after they did 50, and it looked like it was probably not necessary at best and maybe a mistake at worst. So I think they do want to see a little bit more development of the downside risks on labor, but the inflation that you mentioned is a big problem. And I think if you compare this to last year when they did end up going 50 basis points, the inflation picture was in a wildly different spot. 3-month seasonally adjusted rate of core PCE was like 1.9%. Versus 2.6 today. 1 year zero coupon inflation swap. So this is a 1 year measure. You mentioned the survey measure, but the market-based measure is also telling you above 3% inflation for the next year. Back then it was sub 2%. So big shifts. I think those labor risks are still what are driving the majority of the committee outside of Waller and Bowman.
And you know what? I ran my estimate of the optimal interest rate using that 2.6 PCE. It moved from 4.55 to 5%. That now is like me on the edge of, hey, we need to hike rates, not cut rates. And the Fed runs 4 different models, and Powell actually has told people, hey, one of them suggests a rate hike. So yeah, we're not out of the woods.
Well, it was funny, he almost mentioned that in the press conference.
Yeah,
he kind of had that one little
that
spot where he said, well, we might be, we could actually argue that we're ignoring some data by not hiking. I stopped for a second there. He was very quick to kind of go back on that and
also to your point, Blake, that last mini cycle of cutting, if you remember, the long end of the curve had a very different than expected reaction, right? It's not unprecedented But the long end of the curve shot straight up, and that was the bond market telling you that maybe that was not the right policy move.
Can I ask you, Jordan, on a day like this where you have so many dynamics and cross currents, we're talking the jobs report, Trump is making headlines, we haven't even talked about geopolitics, there's headlines about nuclear subs being moved. What is your advice to clients when they call you on a day like this?
Well, first and foremost, this is certainly common advice, but you should have a process, and you should be sticking to that process. We are certainly believers in a systematic rules-based process based on objective, measurable things. But what I think gets said much less often is understand the trade-offs that come with your process, right? So if on a day like today, you find yourself maybe questioning your approach because of, really this is the single blip of volatility that we've had in the last several weeks or last several months, it's as much about measuring your own expectations and about measuring your own behavioral risk as it is about whatever investment process you follow.
Blake, last question. Given your area of expertise, I want to ask you. I'm looking at the 10-year here, Blake. We're back down to 4.2. Where do you see that headed near intermediate term?
So we don't have that retracing as much this move today. Our focus really more on the front end and kind of that steepening that we've seen. I would actually fade that into next week. I think we've gone about as far on the rally, particularly at the front end, as we can without new information on the deterioration in labor, which isn't going to come for a while. And meanwhile, you have to get through a CPI report. We have ISM services, which last summer actually served as kind of the low point. We had a better than expected ISM services print, and that actually represented kind of the turning point. So we have both of those coming up. I really think that as people go home over the weekend, take kind of a more measured rather than reactionary look at some of the data. And I also would expect some of the Fed speakers that we have on tap next week are going to come out and kind of reinforce this calm, measured type of approach. That I'm hoping kind of calms things down. So I think we've kind of seen the worst of the rally. I do expect a bit of retracement, but that's mostly at the front end. I don't think the back end is really going to follow as much. It's mostly going to be that pricing in 2-year kind of Fed expectations over the next year or two.
All right, Blake, Jordan, it's great to have both you guys on set. Appreciate it. And we are just getting started, meanwhile, here on Market Domination. Coming right up, the hard line on deadlines seems to be sliding as the White House continues to cut some tariff deals while playing hardball on others. We have a live report out of Washington on everything you need to know about trade policies. And while Washington is being kind to crypto, we're talking directly with the SEC chair about the agency's efforts in legitimizing digital assets. And investors continue weighing big tech's gravity in the markets and in portfolios. We're looking back at the big takeaways from the Mag 7 earnings results. Those stories and a whole lot more coming right up. President Trump advances his effort to reshape global trade, imposing tariffs on dozens of countries. And here with the latest, we got Yahoo Finance's Ben Worshkel. Ben.
Josh, yeah, a lot to digest of these numbers that were released last night. Hiking tariffs on Canada to 35%, as well as an array of rates on the rest of the world from 10 to 50% that we're going to see in about a week's time. You've already focused a lot already in the show on the market reaction. I want to focus a little bit on the kind of next steps of trade. We're seeing signals, at least from the White House in the last few hours. What Trump's take on this is that these rates are set. The words he's used is it's too late for other countries that don't like the rate they were given to negotiate, even with this 1 week delay. There's skepticism on that front, whether that's going to be the case, but that's his position. And the timeline he set for new deals he threw out in this NBC interview was 4 weeks' time, like maybe there'll be a deal in 4 weeks, suggesting they're pushing ahead. It's also worth noting that Trump's True Social has clearly been popping today on all these issues that you've already been talking about. What he actually hasn't posted about are these tariff rates. He's mentioned tariffs in passing, but not sort of to say why make his case for these rates. And I think that's kind of overall an attempt to kind of put tariffs to bed for now, say that this is the reality and that markets and trade negotiators need to accept it. Plenty of skepticism, obviously, whether this will succeed. We've seen it all day. Capital economics is one example. I had a note that said this is unlikely to be the final word, and there's going to be a lot more back and forth there. But that is at least the White House position at the moment, to put this issue, make this the reality, and then move on to other deals down the road.
What about this idea, Ben, of a tiered approach to tariffs that could be taking shape here?
Yeah, this is an element of this release that was really interesting to me. I've been looking at all day, and it's a real shift between how this was approached now versus how it was approached in April. Just to remind folks, in April, it was purely trade deficit. There was a formula that the White House put out that was essentially just the trade deficit as a percentage of GDP. That led to a lot of really head-scratching rates, 50% on small African countries, things like that. This time around, the trade deficit is still the number one factor, but it's much more of a piece in a bunch of other factors, including kind of subjective ones that the president himself can clearly decide. What it's led to, as you mentioned, is this kind of idea of tiers. We're seeing 120 nations at 10% tariffs, 40 at 15%, 10 at 19 to 20%, and then so on upwards. It gets a little more scattered when you get higher up, but it's clearly an attempt to kind of put these all together into one. What a White House official had said is that the 10% is for folks with a trade surplus, not exclusively, but mostly. 15% is for deals and with a small deficit, and then it gets more bespoke further up. This further up, I think, is where folks should watch going forward. One that jumped out to me is that this 19 to 20% rate are all Southern and Southeast Asian nations. We saw some deals there. The outlier is India, who has a 25% rate. So they're going to clearly want to be aligned, at least with their neighbors, so that they're all having the same rate. So that's where a lot of the fight's going to be in the weeks ahead.
Joe, I want to bring you back in here as well, get your take on the connection you see, Joe, between the jobs report data we got today and the tariffs that my friend Ben is talking about there. I've seen some pushback on that, Joe. I've seen some folks say, listen, no, don't draw that connection. The labor market, it doesn't move that quickly. And hey, look at the GDP report we got. But you say you do see tariff fingerprints on that data.
Yeah, uncertainty has its cost, and you can see in the goods production data, in the manufacturing data, real pullback in hiring, and that's got to do with that uncertainty. Moreover, look, the economy slowed to 1.2% in the first half of the year from a 2.9% close for 2024. There's a reason that happened. So no matter how difficult it is, you can't look away. You have to be a forward-looking investor. You have to be a forward-looking business manager. You can't just say, well, hey, I don't really like this because I don't like the news. Well, okay, that's fine, but you're going to pay for that. So I see it there, and I really see a connection in what's going on, unfortunately, via the immigration channel.
All right. Ben, thank you, sir, for that update. Appreciate it. Now time for some of today's trending tickers. We're watching shares of Colgate-Palmolive, Rocket Companies, and Regeneron. Let's start with Colgate-Palmolive, the company warning of a, quote, persistently cautious consumer in North America. CEO Noel Wallace sees that uncertainty holding in the short term, but potentially getting better as we exit 2025. The warning comes despite the company's beat, by the way, on the top and bottom lines in the second quarter. Organic sales in Q2 did beat estimates, while the company sees sales at the low end of a 2% to 4% gain for the full year. Company also announcing cost-cutting initiatives to support long-term efficiency and growth. Meanwhile, Rocket Company is popping today on its third quarter guidance and strong earnings for the second quarter. The mortgage provider seeing demand accelerate despite the Federal Reserve holding rates steady. Mortgage volume rose 13% from last year and closed origination volume rose 18%. CFO Brian Brown says that the company remains cautiously optimistic about the summer home buying season, which is expected to extend past Labor Day into the fall. And finally, Regeneron pairing earlier gains after reporting a big beat on adjusted earnings per share of $12.89 in the second quarter. That is 50% more than what analysts had been looking for. The pharmaceuticals manufacturer seeing strong sales of its eye drug Iliad HD on Wall Street. Cantor Fitzgerald says Regeneron can meet or beat full-year estimates if that eye drug keeps growing, while RBC says strong sales may help the stock rebound. Well, coming up, a massive amount of companies reported quarterly earnings results in the week gone by. But how do they stack up against each other? We're doing an earnings report card. When we return, stay tuned. Well, Wall Street digesting a whirlwind of earnings, we know, including those from major tech firms. According to FactSet, 66% of S&P 500 companies have reported results for the second quarter of 2025 now. While AI continues to be a top underlying theme this earnings season, we're taking a look at other key aspects to think about. Here to discuss is Macro Talk News founder and Yahoo Finance contributor, Hope King. Hope, let's start just big picture here. What do you make? What's been the big takeaway from this earnings season, Hope?
Well, it's great to be with you on this Summer Friday, Josh. I think the biggest takeaway is that we are gaining a little bit more clarity on how these tariffs are impacting individual companies. You'll recall earlier in the year, a lot of companies withdrew guidance. They have now reinstated it. If you're Ford, for example, but they're also putting numbers now to how much their bottom lines are actually going to be impacted. If we're sticking with Ford for just a second here, they're talking about a $2 billion net hit. You got other companies like Hershey's and Mondelez all talking now about how much their bottom line, their revenues may even be hit with consumer sentiment now being a little bit more negative. And so I know we're going to talk about a lot of other sectors later, but I think the big theme for me is this clarity, but the uncertainty still looms. And that uncertainty, unfortunately, is going to lead to a lot more adjustments up and down. You were mentioning FactSet at the top of this. They actually analyzed that many of the companies were expected to beat their expectations because they had previously lowered them. We know with earnings, it's always a game of expectations. And if you're lowering the bar for yourself, it does become a little bit easier. But now, even with these renewed guidance coming back into the picture, you're seeing those pictures be revised downward. Companies now at least know just how much they're hurting from these tariffs.
What have you learned, Hope, about the consumer so far during this earnings season?
So it's a mixed picture. If you look at UPS as an example, usually this company is seen as a bellwether for the overall consumer market. They actually reported a decline in average volume in this latest quarter of about 7% on a daily basis, which means that consumers are either hesitant about buying because they don't know what the economy is going to do, or they're seeing tariffs being impacted, or they think they will be, and so they're pulling back. And so that's an indication that the consumers are already pretty nervous and have been. And I know we're not talking about tech today, but the fact that people were stockpiling on their iPhones, right, is another indication that consumers are taking action right now with their pocketbooks to get ahead and to manage their budgets more wisely around all of this uncertainty for themselves.
So bottom line, Hope, take out the red pen. Give me the grade, the Hope King grade for this earnings season.
So I love this question, and I gave you guys two thoughts of mine, okay? I don't think it's fair to grade all the companies the same, and I don't think one grade is actually going to do it. I think there are two grades that really have to be given out. One on the vibes, so if we're talking about like gymnastics or figure skating, right, you have the style on the vibes, and that is a C. People are gloomy, executives are still gloomy, so the mood overall is a C, the vibes are a C, but the execution, I think, in the communication of the new impacts to their businesses, that really is a solid B. I think companies are doing a good job of being transparent with what they know is going to happen and what they don't know. So overall, I don't know, what is the average between a B and a C? I guess a B minus?
All right, we'll take it. It sounds about like Josh Lipton's high school. Hope, thank you so much. Enjoy the weekend.
Thank you. You too.
Washington's been given the green light to digital assets. Our very own Jennifer Schonberger sits down with SEC Chair Paul Atkins, talking about the future of stock tokenization and legitimizing crypto.
A lot of times, I mean, there are different ways to tokenize things. And so some of that will be, you compare it to, say, a mutual fund or an ETF. So the ETF is still a security, even though it has securities also in it. It's a basket of securities. So that's the similar thing with a tokenized asset. And but we need to make sure that the rules that apply for disclosure and issuance and all that can accommodate, the special features of tokenization. And it's much more efficient, perhaps, to have a tokenized security than some other sorts of things. But we need to make sure that we have a level playing field, that people are certain how to go forward. So that's going to be unfolding as we address these issues.
And how do you ensure that investors are going to get the best price if stocks are trading on the blockchain?
Well, I think the markets will accommodate that. I mean, obviously, with actively traded things, you have very straightforward. Well, you have the opportunity for current valuation that's, again, because of the way the blockchain works, I mean, that's a transparent aspect. So as the current financial system then adapts to accommodate these new forms of securities, I think there will be, just like we have now, national best bid and offer prices and all of that. I think that we will make sure that new forms of securities will mesh in with the rules, and that the rules will accommodate that sort of trading and that openness and the publicity of the prices.
You're calling for on-chain markets. What exactly are you calling for there? Do you want all securities to be tokenized?
Perhaps. I mean, when you look at the whole arc of history, in the 1960s, things were still in paper form, paper securities, and there was so much trading in this big bull market at the end of the 1960s that the New York Stock Exchange and other exchanges had to close for one day a week just to catch up on the paperwork, and because the data processing couldn't accommodate things. And so, and then sometimes 2 days a week because the volume was so heavy. And it's not that they had quill pens to write in the ledger to, show the transfer of stocks, but, they had to build the systems to accommodate all that. The SEC at the time helped the industry through helping them change the rules so that they could immobilize securities, have book entry. The Depository Trust and Trading Corporation came about, which is a cooperative of securities firms to try to do that book entry transfer of stocks. So that was a huge watershed. So I think we are perhaps at the similar point now where who knows how this technology will develop. I certainly don't have a crystal ball. 5 years from now, it could be completely different. So we want to be in a good place. We're accommodating that. We're not an impediment to innovation.
Under the last administration, the Howey test was used to administer whether a crypto asset was a security or not. And it was deemed that most crypto assets were considered securities. I know you are of the opposite school of thought, that many crypto assets are not considered securities. Is the Howey test germane in your view at this point? Is it applicable, or is the SEC looking at creating a brand new yardstick to create a clearer definition for what defines a security or not?
Well, great question. The Howey test is named after a Supreme Court case back 80 years ago. It had to do with orange groves and oranges. So that's completely different than tokenized securities or tokenized assets. And so what we have to do is, it was a Supreme Court ruling, so that's the law of the land. It interpreted the term investment contract, which is in the securities laws, but Congress in those laws didn't define that. So thus, the Supreme Court took a stab at it that worked for that one particular case and has been applied, for years after. So now we're now in the 21st century, and dealing with digital assets. So the SEC has authority to interpret that term, and so we are going to set out to have rules that comply with the law and obviously build upon that, and to help people understand how that applies to the current situation.
You said in a speech yesterday that in the coming months, the SEC will consider using authorities to make sure that any archaic laws that are squelching innovation and entrepreneurship are revoked. What could we see stripped away?
Well, that's a good question. I don't want to prejudge anything, so we're going to have to do this in a very straightforward and diligent manner, obviously. But there are a lot of things that apply to, say, operating companies like a steel company or something like that that's manufacturing steel that doesn't apply to maybe a digital-oriented company. And so as far as the products go and whether or not those particular products themselves need to be registered as securities or not. So again, we need to make sure that the forms that people need to fill out in order to declare and publicize to the SEC and to the public what their product is, what it's supposed to do, what the innovation is, or what the purpose is, so that our rules can accommodate those particular aspects of these new products.
Switching gears a bit, investors who are eagerly anticipating the proposed Truth Social Bitcoin ETF are going to have to wait because the SEC has apparently postponed a decision on that until September 18th. Could you tell us why the delay? Are there any concerns there, or what's going on?
No, it's part of the normal process of deliberation internally. So it's an active matter, so I can't really comment on it. But just to caution people that just because there is a temporary pause in that, that doesn't mean that it's not going to be deemed effective ultimately. So anyway, so this is a normal process. You look at the other products that come. So there's we're going to get through that, and we'll have announcements to come.
And before I let you go, Mr. Chairman, you have said that you want to make IPOs great again.
Yeah.
What can we expect in terms of rule changes that would incentivize more IPOs?
Well, today there are about half the number of public companies than there were 30 years ago even. And so even broad measures of the number of companies out there, like the Wilshire 5000, unfortunately now there are only about 3,000 companies in that. And so one friend of mine said we should rename it the Wilshire 3000 or something. But anyway, we need to address like three major things that I view as inhibitions for people to want to take their company public, because there's such a huge reservoir of private capital out there now that companies, developing companies, can tap into, that we want to make the public markets attractive. So one is litigation. Two is abuse of the corporate governance system, I think. And then three, which is something that we can especially affect here at the SEC, is the amount of disclosure and of really not material information that we're asking many companies in many cases to disclose. And that, so we will have a spring cleaning, I like to call it, as deferred maintenance that for way too many decades. And so we need to go back to, if you look at disclosure from your companies 40 years ago or more, I mean, it's markedly different today, much, much more. And, 10Ks are, hundreds of pages long at times. And that's just intimidating for normal investors to get through, because we've lost our North Star of materiality. So we will go back to that. And then that will be the lens through which we look at our rules.
All right, our thanks to Jennifer Schonberger for that interview. Coming up, we're going to see more unicorns take their magic public this year. We're taking a look at the IPO market. Is it hot or not? It's coming up. Well, it's been a big week for big tech, with 4 of Magnificent 7 reporting earnings, but Friday's market sell-off eating into some of the gains from tech. Here to help us break it all down is senior reporter Allie Knell with the Yahoo Finance Investor Playbook. Allie.
Hi, Josh. That's right. Big tech's AI spending spree is on a roll here and only getting bigger. We heard from Amazon, Alphabet, Microsoft, Meta, all now expecting to spend a combined $364 billion in their 2025 fiscal year. That's a sharp increase from earlier estimates of around $325 billion. Wall Street certainly cheering this news. We saw Meta and Microsoft shares soar after earnings. Microsoft actually briefly topped that $4 trillion market cap. Alphabet also rallied. Amazon was the lone exception here. Its stock slumped after a weak AWS guidance, spooking some investors there when it comes to where Amazon actually stands in this AI race. Now, these companies have said that spending is essential in order to meet a lot of that surging AI demand, and that includes building data centers, expanding cloud infrastructure. Microsoft alone plans to spend nearly $30 billion in the first quarter of its new fiscal year. Analysts are certainly buying in as well. RBC Capital Markets calling Microsoft's AI footprint underappreciated. Needham saying that Google is leading Gen AI innovation. Wedbush hiking its price target on Meta to a whopping $920 a share. So there's just a lot of optimism on the street. There is some speculation on whether or not these are bubble-like numbers, whether or not the valuation can really be justified, especially as AI returns are still a bit murky and monetization remains unclear. But for now, investors are betting, I should say, that the payoff is just a matter of time here. So just across the board, very solid results, and this all sets us up for NVIDIA earnings at the end of the month. But Josh, judging from what we saw from a lot of these hyperscalers, I think we're poised for a really strong NVIDIA report.
So a lot of important cross currents there, Ali. Generally, how do market strategists feel about big tech?
Very positive and very bullish. And you can just look at the sector action that we've seen throughout the course of the year to really tell that story. Tech is one of the top leading sectors. And conversely, if you look at the biggest laggards this year, that's consumer discretionary, consumer staples. So a lot of these companies that are exposed to the consumer, particularly lower income consumers, they've seen a lot of pain on the tariff front. We know that inflation is edging up a little bit. We got that jobs data earlier this morning that points to a potential weaker labor market than we thought heading into this month. So all of that is really insulated from big tech, or I should say big tech is insulated from a lot of those concerns. Of course, Apple did say they expect to take a $1.1 billion hit when it comes to tariffs in the current quarter, but investors weren't really concerned about that. They shrugged a lot of that off. They're looking at iPhone demand. They're looking at China. There's just different guidelines and different set of rules for a lot of these big tech companies. So that's why it's really been leading a lot of the gains and leading the rally that we've seen this year. All
right. Thank you, Ali. Appreciate it. Well, design software company Figma is seeing gains in its second day as a public company after a 250% rally on its first day of trading. That blockbuster debut setting up another huge vote of confidence for the IPO market after names such as Circle and CoreWeave also saw their shares soar after their public debuts earlier this year. For more on the latest pulse on the IPO market, let's get to EquityZen head of market insight, Brianne Lynch. Brianne, good to see you. So maybe you start big picture, Brianne. You look at the U.S. IPO market right now. How would you characterize it?
Sure. We have seen that, as you said, there's been these blockbuster IPOs that have really proven that there is strong investor interest for companies that are growing rapidly and innovating. Over the past several years, we've had a drought of IPOs, and these types of opportunities to invest in companies like Figma that are growing at 50% plus year over year just really haven't been apparent in the public markets. You know, you had SEC Chairman Paul Atkins just speaking a few minutes ago talking about the number of public companies dwindling. And all this is just creating, increased demand for tech IPOs in particular. So as we look forward, we see a lot of market enthusiasm, but for quality names like Figma that are growing, profitable, using AI in their business models and have strong brands.
So as you look forward, you see enthusiasm, Brianne. I'm curious to get your take. I spoke to a venture investor on this show not too long ago, and I was asking him about the IPO market, and he said, just looking ahead, all the uncertainty with the economy and trade and tariffs, he was saying, I don't know how long that window actually does stay open. He sounded generally more cautious, and I'm just curious to get your take on that.
Sure. Yeah. So there's a lot of market exuberance, which we've clearly seen in some of these IPOs just trading, wildly those first few days. And it's not to say that there is a lack of macro uncertainty. We just talked about the jobs numbers are softening, inflation's pulling up a bit. It's definitely not a straightforward story where it's, all thumbs up, all clear ahead for the future. But for a lot of these companies that have been planning and trying to go public or exit for many, many years, Figma is a great example. They were almost acquired by Adobe back in 2022. That was their milestone or their plan for an exit. So they have been waiting for the right market conditions to actually take the plunge. And there are many other private companies like them, these unicorns that have been private for 10, 15, 20 years, that if they have the right fundamentals, yes, there's some macro uncertainty, but now may be as good a time as ever.
Brianne, which are the possible candidates, in your opinion, that would be on your radar who might be willing to test the public markets this year?
Sure. So, several of the names on our IPO outlook for the year have already gone public, but there are a few that we're still waiting on. One of the big ones being Klarna. This is a company that was planning to go public in the spring, table those plans given the volatility in the market post Liberation Day. But they're reportedly now looking at a September IPO. So that will be the next of several fintech IPOs we've seen. You had Circle, Chime, eToro. So certainly fintech is an area where we're seeing more activity. And given Klarna's brand recognition and value in the market, that's one we have our eyes on.
Right now, if you're going to go public, Brianne, do you have to have an AI story? Do you have to be able to just sprinkle some of that AI magic on your S1?
I would say at a minimum, you have to try. And Figma, that's something that played into their story as well. They had so many case studies of their large enterprise clients saving, lots of time and money because of the AI tools that they've built into their product. So I think that's a table stake for any company that is looking to go public. And that might be the best option for public market investors at the time, because you have to remember a lot of these pure play AI companies are still very young in their life cycle. They're less likely to be going public in the next few years. So yes, that's bringing more investors into the private markets to invest, but to kind of capitalize on that interest, public companies or contenders to go public will also need to have that as part of their story.
Do you think there are certain kinds of private companies, Brianne, that would be more likely to receive a warm welcome in the public markets in this environment against this backdrop?
Sure. I mean, we've seen a few examples of what has worked, talked about a little bit about the need for growth, the need for profitability. But when we look at the companies that may be coming next, or even the IPOs we've seen in the first half of the year, it hasn't been just one sector or one industry. You've seen fintech, you've seen crypto, which is obviously growing a lot. And given, the regulatory tailwinds, we expect that to continue to be a hot market. But then, Netscope, another name on our outlook, that's a cybersecurity company. StubHub, another one, that's an e-commerce player. So it's definitely not, one sector narrative that's driving the market. It's more, are you growing? Are you profitable? Do you have the brand name? And do you have a story that's exciting to investors, especially given the lack of public companies relative to private companies now?
Final question, Brianne. I want to switch gears here because I'm just curious to get your take on this trend of tokenization, Brianne, buying shares of private companies. We've had rules on the books for a while, Brianne. How to invest in private companies, who can invest in private companies. What do you make of this trend?
Yeah, I think the trend just really speaks to the growing demand for individual investors to invest in private companies. It's something we're seeing on EquityZen, where accredited investors can come and invest $5,000 in these late stage pre-IPO companies. And tokenization is one method of providing that access. But I like to remind people that this market is already open to many more investors than it historically has been due to technology and due to innovation that's happening. We see the pre-IPO market as a core market that all investors should have in their portfolio. So we're big proponents of providing greater access. So I'd say that access is already happening. Tokenization is an interesting angle and a way to do that. But of course, we have to think of the private companies themselves and work with them to create frameworks for liquidity and investment access that also meet their needs.
Brianne, great to see you. Great to have you on the show. Enjoy the weekend.
Thank you. You too.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.